Well, good morning, everybody. Welcome to the Reserve Bank and our press conference for our May Financial Stability Report. I'm Alan Bollard, Governor, with me Grant Spencer, Deputy Governor. The outlook for our financial system has improved over recent months, and that reflects a recovery in the New Zealand economy, which in turn has been mainly driven by stronger trading partner growth and by a sharp lift in the terms of trade. However, globally, the financial markets do still remain fragile. The sovereign debt concerns facing some European economies have weighed quite heavily on financial markets in recent weeks. The European authorities and the IMF have recently announced initiatives to support sovereign debt markets and to start to deal with these underlying problems. But there clearly is a risk of further turbulence continuing if adequate progress is not made there. As an external debtor country, New Zealand could be vulnerable to any renewed deterioration in global debt markets. At the same time, the process of international fiscal consolidation could dampen that global recovery, although our major trading partners in Asia, Australasia, look to be less directly affected. Global imbalances have reduced over the past 2 years, with higher savings rates helping to shrink current account deficits. New Zealand has also seen a marked narrowing of its own current account deficit. As for New Zealand households, we are seeing them increasing their savings, which is positive for financial stability. It will be important that households continue to maintain a cautious approach to debt accumulation as the economy continues to recover. Thank you. Grant.
With respect to the banks, they remain in good shape and will benefit from the economic recovery. Non-performing loans appear to be plateauing and notwithstanding recent market hiccups, banks have been issuing term debt over the past year, and this is lengthening the maturity of their structure of their debt and reducing liquidity risk. Bank credit growth was restrained through the recession, reflecting weaker demand for credit and lending standards, tighter lending standards. We believe the banks have the capacity to meet an increase in demand for credit, and will indeed, doing so will be important to sustain the economic recovery. With regard to the finance companies, a gradual rationalisation of the sector is continuing, with the new regulatory regime promoting further consolidation. A number of finance companies have joined the extended deposit guarantee scheme to give themselves more time to get their balance sheets in shape. But we do not expect the banks to enter the extended guarantee scheme, given that there is no need for them to do so. On regulatory reform, significant changes are occurring around the world. New Zealand will participate in these changes insofar that they improve the soundness of the financial system while not undermining its efficiency. As you know, the new prudential liquidity policy for banks became effective in April, and we expect there will be further changes to the bank regulatory regime over the next year or two. And finally, the new non-bank regime should be largely in place by the end of this year, and the insurance bill, which will give the Reserve Bank oversight of the insurance industry, is currently progressing through Parliament. Thanks.
Thank you. Thanks, ladies and gentlemen. We're open for questions. To assist, I've got Toby Fines, Head of Prudential Supervision at the Reserve Bank, and Bernard Hodgetts, who's Head of Financial Stability here. Thank you. Any questions?
Can you hear me? Yep. How worried are you about the lack of credit growth with respect to businesses, and what that might say about the ability of the economy to grow in the future without, at decent rates, without generating inflation?
Yeah, well, at the moment, the business sector is clearly looking at deleveraging debt and really extracting sort of efficiencies they can from existing plant. They do need to invest. We do need to see more investment in plant and equipment happening. That will require more credit, so we will need to start seeing business lending pick up. What's happening at the minute is actually happening in fact, most countries around the Western world anyway at the moment. So there's been really contraction or flattening of credit to the business sector right around the place. We do expect that to start to see pick up. New Zealand needs it for recovery, and I think the banks understand that, and we'd expect to see that happen in appropriate circumstances.
How much of it at the moment is companies paying down debt versus banks tightening criteria? I mean, the business confidence surveys seem to be showing a bit of a pick-up in investment intentions. How much of it is actually banks tightening up criteria?
Well, we saw banks tightening criteria clearly a year ago. That was quite a sharp tightening at the trough of the global financial crisis. We're not necessarily seeing that happening now. We think it's banks are there broadly to lend. We do carry out credit condition surveys. They're not particularly showing a tightening in credit at the minute. So I guess we'd say generally it's business that's being pretty cautious at the moment.
Dr. Bollard, how would you describe this backdrop to be delivering a budget in?
Well, we're not discussing the budget matters. Of course, we're simply talking about financial stability, which continues to improve, with that one particular point that we point to, which is that sovereign financial markets overseas do get a lot of attention still.
Dr. Bollard, how serious are you about the idea of raising and lowering a core funding requirement as a cyclical, macro instrument?
Yeah, look, at the minute, we've got a core funding ratio in place. We see it primarily there to help promote liquidity in the system. That looks like it's working well. We'll be cautious about how that continues to work over the next little while. We have, as you know, discussed the possibility of whether it could also have an additional role as a macro financial instrument. For us, that's broadly to be seen more like an automatic stabiliser, something that's there that you hope would be helpful through a cycle. We believe that might be the case. I suspect the cycle to test that is still a little way off. As for a more discretionary use of that in a sort of shorter term sense, would we move that core funding ratio around? Well, we look at these things, but we don't have any particular expectation of that at the moment.
In terms of the international risks, you mentioned the sovereign debt issue, but what about the risk of a credit or asset bubble in China going pop? Do you have any concerns on that front?
Well, that is a risk. I think all of the Asian countries are seeing significant capital inflows, and a lot of that's going into the property market. So those countries, including China, are concerned about the growth in property prices in particular. A lot of them are countering that with various what we might call macro-prudential tools, such as limits on loan-to-value ratios, debt-to-income ratios, that type of thing. And they have been having some success with that. And I was at a meeting last weekend with a number of these countries, and they are pretty determined to keep on top of these property booms to prevent it being a bubble that might burst, and I'd be pretty confident that they stay on top of it.
If you look for where financial market concerns are, though, they're very clearly in Europe, not in Asia.
What could the Reserve Bank do to force the banks, if necessary, to reverse their tightening of credit that they've shown since the end of December?
Well, we're not looking to force the banks to do anything particularly. It's not the way we or the banks have had to operate. There is competition in that sector. Actually, I think the banks are probably looking quite actively at ways that they can induce quite a cautious business sector to borrow more at the moment. So it's very important that banks remain open for business. They clearly are, and we're not looking to force them to do anything.
Why do you think then that they have tightened their credit standards, as you point out in your report, since December, given the outlook for the economy has improved and they remain relatively strong and liquid?
Well, I mean, the tightening of credit standards happened way back in 2008, and they've been applying those more realistic standards. I think you could say the lending standards were probably too loose prior to that during the boom period. And those firmer standards have been in place since 08, 09 and into this year. And that, as Alan said, the flat credit's been a sort of a mixture of those sort of supply effect as well as the deleveraging on the part of households and businesses. I mean, the main thing we want to ensure is that, you know, we don't think that's been a constraint so far, but we don't want it to be a constraint in the recovery. But it's pretty clear to us that the intent to lend is there. The doors are open for business. But so far the demand is not coming through.
But you mentioned here on page 24 of the report that information gathered through the QSBO and discussion with business contacts show that the availability of finance has tightened further since December of 2009. So this is a relatively recent thing, which suggests it's not just a demand issue, it's actually a supply issue.
I just wonder, Bernard, do you want to update from the latest survey on that?
Yeah, I mean, we're looking at a variety of sort of measures of credit availability, but I think the point would be that most of the tightening in conditions, certainly as we've monitored it, appears to have occurred, you know, a year or so ago. So it's really a case of the things having stabilised over the last sort of 6 months more than there being an appreciable further tightening. But certainly there hasn't been a noticeable loosening in credit availability through most of the surveys that we look at.
Dr. Bollard, how likely is a renewed deterioration in global debt markets?
Well, I think what we've seen over the last couple of months just reinforces something that we did learn from the experience of the 1930s, which is when the world goes into deep recession with a big financial and banking crisis, recovery is very slow and it's unpredictable, and it goes through deteriorations as well as improvements. And it's not always easy to predict just where those will be. But what we've clearly seen over the last little while is that financial markets have realised the sort of debt burdens that the governments around the world in some cases have taken over from the financial sector, and it's also exposed some poorly managed fiscal stories as well in certain countries like Greece. And where that's happened, the financial markets have also started doing the arithmetic and adding in the costs of financing continued obligations that we always knew were there but were out in the future, like demographic growing old age costs. And as they put those together, they've become quite nervous about some of the fiscal financing requirements for some of those countries. And you've seen that happen in a country that can't go through normal fiscal adjustment through an exchange rate depreciation, Greece. And you've seen it bubbling around within the European Union to a significant extent. We think that's been that the liquidity issues have been plugged by that package that's been put in place, but that doesn't mask the fact that there is a real structural issue in all of that, which is how some of those heavily indebted countries are going to finance their debt and pay for it out into the future. Financial markets are only really now absorbing some of that. So I think it's reasonable to expect some instability in some of those markets. Luckily for us, those are in a completely different part of the world. They're not currently affecting us very much, although we do watch how that has spilled over into bank financing markets over the last couple of weeks a little bit. We'll keep watching that sort of thing, but it can bubble away.
How has the sovereign debt problems affected the local bank's ability to raise money?
Well, the tightening in debt markets generally has mainly focused on the banks around the world that are exposed to Europe. So, well, there has been a general tightening, so it's been more difficult to get funding, particularly term funding. But the main constraint, as I say, is if a bank is perceived to have exposure to Europe. And our banks pretty clearly do not have any significant exposure to Europe. And so while things have tightened somewhat for them, it's been considerably better than, say, for European banks, say German or French banks that would have exposure to southern Europe sovereign debt.
So not much in the way of problems for our banks raising money on those markets then?
No, but it is. I think it's fair to say that the term markets are pretty well on ice at present. There's still this, but certainly the short-term funding is continuing.
So if the term markets are on ice, does that mean anything for the central bank having to support that sort of lending and borrowing by the local banks?
We don't expect so. I mean, it's only if that sort of situation continued or deteriorated. And at present, after the volatility of a couple of weeks ago, things have been stabilising and I would say improving. If they continue to improve, then that's a temporary hiccup, which we'll get over. The risk is that, if this thing deteriorated further, and at the end of the day, the markets are really looking to assess how well European countries handle this fiscal problem. In other words, are they making progress to correct the underlying imbalances? Is the funding programs from the ECB and the IMF, are they sensible? Are they not going to be properly funded, not be inflationary? Those are the concerns the markets are looking at, and as long as things stabilise, then this will be a temporary glitch, and the underlying trend of overall improvement in the economy and financial markets will continue. But clearly the risk has increased.
Just one last question. You say that you don't see any need for the local banks to join the retail deposit guarantee after October. Should the banks at the moment are saying that no decisions have been made yet, do you think that they should be making those decisions now? And is there any issues around sort of transparency of deposit rates, interest rates that stretch past that October end date?
Can I just answer that? I mean, it's up to the banks to make that decision. They've got to make it individually. It's their commercial decisions to make. But we think generally it would be helpful to be able to give clear indications of that so that the market and depositors can get a clearer view about where that's going.
Surely it has to be more than a temporary glitch if the Europeans face a pretty stark choice between fiscal integration and monetary disintegration. Satisfying the markets about the former will take, they've got a credible plan for the former, must take some time. And in the meantime, isn't New Zealand exposed to rising global yields and higher interest costs, given our reliance on imported savings?
The way that it's happened so far has been reasonably contained in the European system. I mean, you're right, this has been the first tough test of whether or not the fiscal disciplines have worked. And initially they haven't. And of course the individual monetary mechanisms aren't there to sort that out. But that's an internal European decision. They've recognised that. They've found it very difficult to deal with it, but we hope they have dealt with it. I think that is a question of this particular monetary union rather than a broader issue. I'll probably just add, though, that a number of those countries do face very severe fiscal retrenchment that will slow their growth prospects in the future. That, of course, will impact countries trading into Europe. We trade into Europe, but our European exposure is much less than it used to be 20 years ago.
Are you confident that you'll be able to increase the core funding ratio of the major banks to that 75% level within 2 years, given that some of the banks are saying that this will increase their funding costs and that they would have to pass that on to customers?
Well, the plan is, as you know, to move it from the current 65% to 70 and 75 over 2 years, but we have also said that that calibration will be assessed as we move through time, so that if that is putting more pressure on funding costs and financial markets generally than we expect, then we could moderate or modify that transition path, and we have said that to the banks.
And are there any signs at present that you might need to modify or moderate that path?
That's not apparent as yet, no.
One last one from me. Basel III, what's your current assessment of what we might get out of Basel III and when?
Well, they're looking at all their submissions on their proposals that they put out late last year, and their intention is by the end of this year to come out with a fairly clear set of proposals, calibrated proposals. So the set of proposals will be firm by the end of this year, but then the actual implementation would be over 2011 and 12, so it'd be a sort of 1 to 2 year implementation period. But of course, once that list is made apparent, there's going to be a lot more debate and feedback, and I would say, potentially further iterations and adjustment before this thing is finalised, because it has so many moving parts.
Could I just add on that we did have some concerns with some of the proposals that we saw as being not particularly relevant or even distorting for the New Zealand system. We're encouraged by recent developments from G20, currently chaired by Canada, where Canada and Australia and some other countries have expressed the same view, and we hope that will help to filter out some of the proposed measures that really look like they're designed for European, North American systems rather than this part of the world.
And the Canadians are arguing against a bank levy tax. Would you be in with the Canadians on that?
Well, that hasn't really been an issue for us here. So again, it doesn't look highly relevant for New Zealand.
You've made reference to raising the official cash rate in coming months. And I just wondered, given the turbulence or the potential for turbulence in Europe, if that is a factor that you would look at when it comes to deciding when to raise the OCR, and could it potentially push it out a little bit further?
Good try, but this is about financial stability report. That's all we're talking about, sorry. Okay, well, thank you. Before this conference takes a turn in other directions, we'll terminate it. Thanks very much for coming, everybody.